In 1955, a psychologist put a group of people in a room and asked them the simplest question imaginable. Which of these three lines is the longest? The answer was so obvious. A child could see it. But here is the twist. Most of the people in that room were paid actors. They had been briefed beforehand to point at the wrong line, confidently, unanimously, without hesitation. Only one person in the room was a real participant. And that one person, faced with a room full of confident, wrong people, went along with them 75% of the time. Think about that for a second. These participants were not confused. They were not guessing. They could see the correct answer with their own eyes. But the moment a unanimous group said otherwise, their brain began to question what their eyes were telling them, and they lied. Not to deceive anyone else, but to avoid the discomfort of standing alone. That experiment, Solomon Asch's conformity study, was not about vision. It was about trading psychology before trading psychology had a name. It was about every new Forex trader who has ever looked at a chart, screaming, "Don't enter," and hit buy anyway, because everyone on Twitter was calling it a sure thing. The market doesn't punish bad analysis half as brutally as it punishes one thing: doing what feels socially safe instead of what is actually right. So, before we get into the rules, ask yourself this. Right now, today, what are you conforming to in your trading that feels completely wrong? Because by the end of this video, which you can call a guide to Forex trading for beginners, you won't just be able to name it. You will know exactly how to stop. Forex trading rule number 1. Don't trade EURUSD if you're a beginner. In 2019, a Reddit user known as ForexKing_99 posted what looked like a modern-day alchemy story. He turned $500 into $50,000 in 6 months, trading nothing but EURUSD. Screenshots showed explosive gains. Commenters called him a genius, and some even begged for his secret strategy. 6 months later, he returned with a single brutal update. New account balance is $487. His explanation: turns out watching paint dry is more exciting. I kept overtrading just to feel something. And that is where most people stop reading. They chalk it up to poor discipline, weak trading psychology, a guy who got lucky and then got greedy. But that explanation only tells half the story. And the half that gets left out is the part that should make every new Forex trader watchful. This is what ForexKing_99 probably never knew. EURUSD is the most traded currency pair on the planet. But that is not a feature. That is the trap. And if you are serious about Forex trading as a beginner, this is the first thing you need to understand about Forex pairs to avoid. The traders at the big banks, the ones with real capital, real infrastructure, and real visibility into where retail positions are sitting, they go where the most money is clustered. And the most money is always clustered in the most popular pair, always. These institutions can see where retail traders are positioned. So, when the crowd goes long, the banks know exactly where the stop losses are sitting beneath price. All they have to do is push price down far enough to trigger them, collect the liquidity, then reverse in the original direction. The direction the retail trader was right about, just 6 pips too early to survive. Between 2008 and 2013, traders at Barclays, Citigroup, and JPMorgan were doing exactly this inside private chat rooms with names like the Mafia, spending 5 years colluding to rig EURUSD daily. When it unraveled, they paid over $10 billion in fines. ForexKing_99 was not just overtrading a boring pair. He was sitting at a poker table where several players had been reading each other's cards for years, and the house had been in on it the entire time. So what should you trade instead? Aussie dollar USD. It moves with purpose, driven by commodity prices, Chinese economic data, and RBA policy shifts you can actually read and anticipate. It does not sit still long enough to psychologically break you, and when it sets up, it tends to follow through. The fundamentals still show up to work. And as a general Forex strategy rule, avoid dollar against Turkish lira and the dollar against the South African rand entirely. Their spreads are so wide you could drive a truck through them. That is not trading. That is a direct, non-refundable donation to your broker's yacht fund. Speaking of brokers and trust, most operate with zero accountability. They answer only to their profit margin. But there's one broker doing things completely differently. They're the first in the world to be held accountable at the highest international level. I'll tell you who they are at the end of this video. But first, finish these rules, because the right broker only matters if you know how to trade. So, stay with me. Rule 2. The best day to trade is the day that fits your schedule, plus has liquidity. The trading week has a personality. And once you understand it, your entire Forex strategy shifts. You stop showing up randomly and start showing up strategically. Monday is the market's warm-up lap. Institutions are cautious, volume is thin, and price action is often erratic, not because opportunity doesn't exist, but because the big players are waiting for the week's first economic signals before committing real capital. Fighting for clean setups on Monday is like arriving at a party 2 hours early. Technically possible, rarely rewarding. Tuesday is when the engine turns over. Activity picks up sharply as the market establishes its directional bias for the week. Your first genuine window for high-quality entries. Wednesday and Thursday are where the real money moves. Wednesday's triple rollover, where 3 days of swap interest are applied simultaneously, can make price behavior slightly more predictable for certain strategies. Thursday, historically, is the single most volatile day of the trading week. EURUSD averages around 145 pips of movement. GBP/USD stretches to roughly 160. Compare that to Monday's 80 and 95 respectively, and the difference is not subtle. If you are going to be at your sharpest any day of the week, make it Thursday. Friday is a tale of two sessions. The morning, especially the first Friday of the month when NFP drops, can be explosive. But by early afternoon, liquidity falls off a cliff as traders close positions before the weekend gap. What looks like a trend at noon can reverse without warning by 2 p.m. Trade Fridays early and exit clean. Zoom out further, and the same logic applies seasonally. January through May and September through November are historically the most active and trend-friendly periods of the year. August and late December are the market's version of a long, quiet exhale, reduced liquidity, unpredictable swings, and very little worth chasing. Rule 3. Don't ignore the daily chart. In 2022, a Twitter trader with 50,000 followers posted a perfect intraday setup on Tesla. Beautiful flag pattern, clean entry, stellar risk-reward. He was so proud he screenshotted his 5-minute chart. What he did not screenshot was the daily chart, which showed Tesla hitting major resistance at a 2-year high. The perfect setup collapsed within the hour. His followers got a live lesson in hindsight bias. He learned about the block button. This is one of the most repeated mistakes in Forex trading for beginners, and it comes down to a gap in Forex strategy thinking. Day traders love to say, "I trade what I see." What they see is a 15-minute chart. What they are missing is the structural reality that daily and weekly charts reveal. The daily chart shows you where institutional money actually lives. It shows you why that random support level on your 5-minute chart keeps holding, because it is a weekly pivot that algorithms are programmed to defend. Trading intraday without checking the daily is like navigating a city using only a magnifying glass. You will see every crack in the sidewalk and walk directly into a building. In 2019, a study of 1,200 retail traders found that those who checked higher timeframes before entering had 34% better win rates. The others were too busy zooming in to notice they were swimming against the tide. Rule 4. Avoid trading major news events unless you're experienced. On June 10, 2022, the U.S. released non-farm payroll data. A trader named Pipmaster 5000 decided he would just scalp the volatility. He placed a tight stop loss. The spread on EURUSD widened from 0.1 to 15 pips in 0.3 seconds. His stop did not trigger at his level. It triggered 40 pips away, at whatever price his broker could find in the chaos. His controlled risk trade cost him 8% of his account. The NFP number? It was revised 2 weeks later anyway. Major news events, NFP, FOMC, CPI, are not Forex strategy opportunities for beginners. They are liquidity black holes where your stop losses become suggestions and your analysis becomes irrelevant. In January 2024, a CPI release moved the US dollar index 1.2% in 4 minutes. That is a year's worth of normal movement compressed into the time it takes to make coffee. Experienced traders can navigate this. They understand market structure, use options for protection, and know which data feeds are fastest. Beginners just know that their account is smaller and their Twitter feed is angrier. Avoid the first 30 minutes after major releases. Your future self, sipping coffee instead of staring at a gaping loss, will thank you. Rule 5. Don't watch your P&L in real time. This is pure trading psychology, and it might be the most important rule on this entire list. In 2020, a prop firm in Chicago conducted an experiment. 2 groups of traders. Same strategy, same risk parameters. Group A could see their P and L fluctuate in real time. Group B saw only price action, with P and L revealed after market close. After 3 months, Group B outperformed by 23%. Group A had higher cortisol, the stress hormone, more overtrading, and one trader who literally developed a twitch. Your brain is not designed to watch money appear and disappear in real time. It is designed to run from tigers. When you watch your P&L tick up and down, your amygdala, the fear center, hijacks your prefrontal cortex, the rational decision maker. A 2017 neuroeconomics study showed that traders who checked P&L during open positions made decisions 40% faster and 60% worse. And this is where trading psychology separates the traders who last from the ones who blow up and quietly disappear. That floating profit feels like money you already own. When it dips, you feel robbed, so you exit early. That floating loss feels like a threat, so you move your stop to give it room. Both reactions are emotional, not strategic. Neither belongs in a serious Forex strategy. The fix is simple, and it is one of the most underrated pieces of advice in all of Forex for beginners. Cover the number. Trade the chart. Check your P and L after you close, when the dopamine and cortisol have settled and you can actually learn from what happened. Do you remember the broker I mentioned earlier in the video? Ultima Markets became the first CFD broker in the world to join the United Nations Global Compact. This is not a marketing badge. It is the UN initiative that holds companies accountable for ethics, transparency, and anti-corruption. They report their business practices to the United Nations. When you're starting out, you need more than a good strategy. You need a broker you can trust. The link is in the pinned comment and description. If you're serious about trading with a broker committed to doing things right, check them out using the link now. Trading psychology runs deep, and Forex trading for beginners has more landmines than any single video can cover. So, if there is something you have personally experienced, a mistake, a pattern, a trap that caught you off guard, and you feel other new traders need to hear it, drop it in the comments. You might just save someone's account. And if this video gave you even one thing you did not know before you click play, the like button costs you nothing and helps this reach the trader who needs it most right now. And if you want to go deeper, because one video is never enough when you are starting out, the next one is already linked on your screen. Click it. What you learn in the next few minutes might be the piece that actually makes everything else click.